Hi, my name is James Robinson. I manage money for a living, and this is my stock pick of the week. This is part 5 in my 5-part series on the company EXPD, which is known as Expiditors International of Washington. This time we're going to talk about the company's wealth creation characteristics. And so what I'm really looking for here is the management has done a good job of operating the company. They've done a good job of managing the balance sheet. They've done an okay job of paying dividends. But what else are they doing to enrich the shareholders? A certain amount of money that comes in every day, and I don't want to see that squandered. I want that to come directly to us in one form or another as the owners of the company. And now there's a number of ways that management can choose to do that. They can retain the earnings in the company and by and through retaining those earnings, reinvest in the company and grow the company. Fine, I'm happy if they do that. They can pay me dividends. That just means I get my money out of the company sooner. Fantastic. There's a downside to that, and that I got to pay some income tax on it, but it's still a win. I've got money coming in. They can choose to buy back shares. I'm happy if they do that. They can put some money into the company in terms of paying down debt. Again, paying down debt reduces interest expense. It makes the company have a bigger buffer should they need to borrow money in the future. I have no trouble if the management does that. I don't really care which of these things. They can also, hoard money in their forms of cash. I don't really have a problem if a management does any of those things. I just want to see that what the company is doing, what their management is doing is sensible and is generating profits for the company. And so that's what we're going to talk about today. The first slide here we're going to look at is stock repurchased by the company. Again, you can see that the company didn't do much repurchasing of stock until about 2011. But since then, it's gone from about 210 million shares outstanding to about 165 million shares outstanding. That's about 25% of the company that's been repurchased. That's really wonderful. I'm happy that they do that. I'd like to see them continue to do that. It's a tax-free way of enriching us. And the way that that works is the company, let's just say the company's earnings were flat. If the company's earnings are flat and they buy back 10% of the company's shares, then the earnings are being divided up over 10% less shares, and that makes the earnings per share go up. When the earnings per share go up, if the PE is the same, that makes the value of the stock higher. We also are entitled to likely the same amount of dividends being divided out over a smaller number of shares, which means dividend yields are likely to increase. It's something management likes to do because it makes it easier to hit their numbers. Their earnings per share goes up. Even if their earnings stay the same, the earnings per share will go up because they have less shares to pay it out. So management's able to demonstrate that they're growing the company and they're using our money to do it. Again, because there's benefits to us as the owner, I don't have a problem when they do that. So this company's doing a good job of repurchasing shares. When you look at that and the dividend, you start to see that they're directly and indirectly enriching the shareholders from the profits, and I'm very happy with that. So let me kind of go over with you a different way of looking at the share repurchase and how that affects us as a shareholder. So if you'd owned 10% of the stock in the company in 2011, let's say you're a giant shareholder and you went out and bought 10% of the shares, you would have owned about 21 million shares. Today, through stock repurchases, your 21 million shares would mean your ownership in the company has increased from 10% to 12.6%. So that's a 26% increase. So you've spent no money, you've been paid a dividend the whole time, you've just been sitting there as a passive investor, and your ownership in the company grows every year because the company's buying back shares from other people, and so you own a larger piece of the company. That's great. Your share of the company's earnings, however, would have gone from $34 million. So whatever the company earned about $340 million in 2011. So your share as the owner, effectively, the beneficial owner, would have been $34 million. So it's gone from $34 million to $88 million over the last 10 years. Now, some of that is the earnings have gone up, but some of that also is the fact that you own 26% more of the company than you used to. I looked at another way, your earnings per share would have gone from $1.62 per share to $4.15 per share. So that's an increase in earnings of 255% over the last 10 years, some of which is the result of the fact that this company's bought back so much stock. Another thing that we should care about as stockholders is how much equity do we have? So again, stockholders' equity is, I'll look at all of the company's assets minus all of the company's debts. And over time, you like to see that number increasing. You like to see that the assets that the company has are increasing over time. It used to be that the stockholders' equity might be a metric of what the company was worth. It's not as important now. Companies have changed since the way they were valued 40, 50, 75 years ago. But having stockholders' equity that is going up over time likely means the value of your company is going up over time, and it likely means that we're going to do well as a shareholder. We certainly don't want to see it going the other way. And so you can see here that the shareholders' equity of this company, with the exception of 2 years, has gone up basically every year. And the equity per share has gone up even faster. Again, we've talked about the company's bought back about 26% of the shares over the last 10 years. So shareholders' equity is moving in the right direction. This is a litmus test that I like to see companies pass. It's not a buy, don't buy kind of thing. But it's, again, just an easy thing to look at to just see how we're doing. One of the things that I look very closely at, and that's very important to me, is return on assets. So there's an old saying, you have to have money to make money. And I think I say this in every slide, but that's not really the measure. The measure is how much money do you make off the money you have? If a company has a tremendous amount of assets tied up and they're only able to throw off a small return on investment, that's a bad sign. I like companies that are able to generate a lot of money off of a few dollars of investment. And that is likely to mean the more money that they retain as earnings is going to generate outsized profits in the future. And you can see this company has been in the top 10% of companies in terms of return on investment literally since 2021. That's a spectacular sign. This alone would make me very likely to buy a company. I'd almost have to have really good reasons not to buy a company when I see a chart like this for return on assets. So this is looking at return on shareholders' equity, and that's juxtaposed to return on assets. The difference between assets and shareholders' equity obviously is the debt component. So oftentimes a company can have, let's say you have $1 billion in assets and you had $100 million of earnings, that would be a 10% return on assets, right? Well, let's say you had the same company, but they had $1 billion in assets and they had $500 million in debt. They would then have $500 million in equity, and that same $100 million in profit would be a 20% return on equity. And so one would argue if you're getting a 20% return on equity, that's really, really good. The problem is that what you're really doing is rewarding companies for taking on debt. And I don't like to do that. I like to have companies that have no debt. And so when you start valuing return on shareholders' equity, you're really saying we'll give you a pass on the debt. And we'll, in fact, value your company more based on the amount of debt that it has, because the more debt you have, the more the equity number is lower than the asset number, and the return is so much higher. So that sounds maybe convoluted, hopefully not. But again, I don't like to look at return on shareholders' equity. Having said that, this company has always been in the top 25% of companies in terms of return on shareholders' equity, and surprisingly, they've done that with absolutely no debt. And in fact, in 2019, the company was in the top 10% of companies, even including the fact that it doesn't have any debt. So that's a spectacular sign. But again, I saw all I needed to see on the return on assets slide. One of the things that a company can do with its earnings is to retain those earnings. And when a company retains those earnings, that just means that they're going to try and utilize them in the business to grow the business. I don't have a problem with a company does that, especially when they have a very good return on assets, because the return on assets means the money that's being retained is generating good results. This company doesn't retain very much money. In fact, several years in the last 10, they've actually had negative retained earnings, which means they've given us more money than they've retained. That's spectacular, especially when they're able to grow earnings while doing it. So this company has a very de minimis need for cash to run its operations, which we really like. I actually wish they needed more cash, because based on the return on investment they're getting, the more cash they were able to utilize, the better for us, the shareholder, the more we'd be enriched. But most companies can't find an intelligent and effective way to use cash, and so I'm happy that they're not retaining it. I've really tried to figure out the way that I can get a sense of the value of retained earnings, and I'm not sure there is a correct way to do it. I don't know if it is, but what I've come up with is I've simply said, how much money has a company retained over the last 10 years? And then how much have the earnings increased over the last 10 years? And I've literally decided that for the purposes of this analysis, 100% of those increases in earnings is a result of the retained earnings. I know that it's not. I know that's an oversimplification, but it's at least gives me a benchmark. And if I see that a company isn't able to grow their earnings at 10% of retained earnings, then they're probably not using that money efficiently, and then I don't want them retaining earnings. If, on the other hand, they're able to generate significant returns on the retained earnings, then that's a really good sign. And you see with this company, they're up over 35 or 40% on returns on retained earnings. Now, it helps that several of these years they actually had negative retained earnings. But long story short, I have no trouble with this company retaining earnings. I wish they would do it more, because they seem to be utilizing that money very, very efficiently and effectively. I talked about this earlier, but one of the things that a company can do with the earnings they have is simply retain it as cash. They put it in a war chest to be used later. They make sure that they have enough reserves to cover the current liabilities, which may well be growing over time as the company continues to grow. And so this company has, as we've demonstrated in earlier slides and earlier videos, has done a great job of building up cash. I don't think they've built up too much, but they've erred on the side of building up too much versus too little. It's, I think, a good sign that they're likely to increase dividends at a larger and larger rate because, or maybe ultimately buy back a bunch of stock. And by the way, based on the current price today, I think they should be buying back stock instead of increasing dividends because I think the stock is a bargain. But I don't, again, one of the things they can do is build up cash, and they've chosen to build up cash. So in addition to paying dividends, which are very nice, they've done a great job buying back shares. And on top of that, they're creating the company's value by increasing the cash on hand. So when you add up all of those things, the annual change in debt, this company hasn't had a change in debt because they have no debt. They have paid dividends and increased the dividends. They've had stock buybacks and bought back basically 25% of the company in 10 years, or 2.5% a year. They've increased the cash flow. When you look at all that and say how much cumulative annual income has this company created for us, the shareholders, over any 5-year period, you can see that they've done a great job on this. And so they're generating wealth for the shareholders every year and over every 5-year period of time. So this is wonderful. And, again, I can't say enough about this company. The operations are solid. The dividend is growing at a reasonable rate. The balance sheet is absolutely rock solid with no debt and tons of cash in the bank. And the wealth created for the shareholders, return on investment is there, buying back stock is there, dividends are there. This is a very, very solid company, and you should buy this company without any concerns. It's going to do great in the future. So that's it for the EXPD, Expeditors International of Washington. Thank you much for your time. Again, I manage money for a living. If you think I do more research on stocks than you do, and you might be interested in having me manage your money, please reach out to me in the comments below. Thank you very much for your time.